Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of the XTB, and you're watching our weekly webinar, which has a title of When Will This Game Stop? Obviously, it must relate to the GME stock that caused a lot of hype on Wall Street last week, but also had huge impact on other markets, and investors are right now thinking, could this be replicated elsewhere? Could this be replicated on the silver market, for instance? So these are the stories that we'll discuss during today's webinar. But let's start traditionally from the top news section, where you can see that on this chart we'll also touch on the economic activity. But let's start from, of course, the craze that we saw last week. It started with GameStop, but it also had impact on other highly shorted stocks and silver market that is rising quite a lot today in the morning, and these things we will discuss in a minute. So let's move on to the other stuff, like strong tech results, Fed meeting that we had. These were the key points in the calendar last week, but they were completely overshadowed by this Reddit movement. We had mixed PMIs from Asia today, weaker PMI from China, slightly stronger PMIs from India and Japan. But doesn't seem to matter for the markets right now. However, what's important here is that a situation in Europe remains relatively tough. There is no outlook for easier measures for easing of restrictions, and especially in the UK. As you can see on this chart here, this is a Bloomberg chart showing you levels of activity measured by different data, and as you can see, the level that we have now is not only way below what we had before the pandemic started, but it's also quite a bit lower than what we had in the autumn, when the market was afraid, for a while at least, of the second wave of the pandemic. But then there was a hype related to vaccines, and the market narrative, look at this, is right now that, look, we have vaccines right now, maybe it's tough, but we are already in nearly in the recovery phase. Whereas where you look at this chart, it shows a completely different picture. It shows that the economic reality is grim. So this is another proof of disconnect between the reality and the market narrative right now. Moving on, news from Myanmar, where military-sized power, not something that will have huge impact on the markets. And in the calendar this week, you have PMIs and ISM in the US on Monday and Wednesday, Bank of England on Thursday, and the NFP on Friday. Technically, it's quite a rich calendar. It's a calendar with a lot of releases. However, it can be easily overshadowed by things like this, by all this Reddit movement that has an impact on all the major markets, especially stocks and indices, but right now also commodities. But let's start with the GameStop story, and what it is and what does it tell us. So first of all, just to quickly introduce you into the concept of why this stock soared so much. GameStop is a loss-generating network of brick-and-mortar shops in the US. So basically, it's a store where you can visit, take a look at the shelves, pick up the box with the game, pay for it and play at home. So this is what we had, I don't know, 20 years ago, 10 years ago. That was a way of making these kind of purchases. But obviously, the world is changing quickly. And right now, if you have a console, for instance, like PC4 or PC5, and you want to have a game, more likely than not, you're not going to go to the physical store, but you're going to just visit a store in the software and purchase a game there. So even before the pandemic, the stock was in troubles and the results were deteriorating. However, the pandemic was another blow, because obviously all the physical stores were either shut or had some restrictions, or 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 there were some kind of mental limitations on customers that were not willing to risk their health, visit the store and make purchase. Obviously, the stock is not doing very well right now and is generating a lot of losses, which seems to explain why there is so much short positions of the funds. However, the idea was, look, if there is a lot of short, the stock is illiquid. So if we generate a lot of demand for whatever reason, even if it's completely not related to fundamentals, we can cause this short covering. We can force the short seller to purchase his this stock back, even at much higher prices, and we can ignite a rally, right? A self-sustaining rally, at least to some point. So that was the whole point. It wasn't like, this is a great stock, let's buy it, let's share the news because this is reality changer. No, it was like, whatever the business is, it doesn't matter. What matters is that it's concentrated in short, and if we force the short seller to cover, we can see a huge rally, cause him a loss, and profit from it. So obviously, this happened, and at the same time, traders and the whole Wall Street started to gaze at all the most shorted stock in the US, which you can see in this table, and of course GameStop is at the top, but you had also a lot of other stock, like for instance AMC, which was popular last week as well. And with this game, you need to be careful, because obviously if you are very early, which needs to be really early, then you can be at this beginning of this Ponzi scheme, because this is pretty much a kind of a Ponzi scheme that's going on. There are some people early in the process who ignite this, and obviously if they take profits on time, if they book profits on time, they can realize huge returns. However, the majority of people entering GameStop or other stocks at these sky high prices, not related to anything, they will stay with, for longer term, they will stay with nothing, because these stocks are not worth nearly as much as they are being priced right now. They're worth much less, if anything, and obviously these stock prices will not be able to remain at these levels indefinitely. So this is what happened. And before I move to silver, I wanted to go through other topics. So first of all, what does this remind me? It reminds me of situations from 20 years ago when we had this pinnacle of the dot-com bubble, and we had stocks that were losing money. They very often had good business ideas, like Priceline, which is Booking.com right now, so it's a very successful company. But back then it was it was a loss generating company, even at the operational level, but generating losses and spending a lot of money on marketing was the hype among investors, and was the precondition of a huge rally. So this is what we had then, and just ahead of the peak, we had the IPO of Pets.com, another idea which even got the seed money from Amazon, the e-commerce store that was selling stuff at the loss at the operational level as well. So what we can see right now is that we already had a couple of typical characteristic of the bubble, which were extreme valuations, entry of a lot of new retail investors, potentially toxic instruments like equity call options, which you can see that this blue line is skyrocketing, and the upbeat narrative that, like I said at the beginning, we have a recovery, we have vaccines, everything's going to be great, stocks will go up forever. And on top of this, we also have things like this GameStop hype which has nothing to do with valuations, and you have an impression that with all of this free money that the central banks are printing, you can create valuations of any sort, and they no longer needs to be justified. So this is obviously one thing that you should have at the back of your head, because at the end of the day, it can be a step too far and the bubble may burst. But what to do? Of course, we don't know exactly when the bubble is going to burst, so we need to play around until it happens. And what you can do is, first of all, you can watch charts, which we'll do in a second, but you can also watch a put-call ratio for S&P 500, for instance, and you can see that when the market is extremely overheated, you can either go short or hedge your equity positions with short positions CFD. And I mean by this put-call ratio at or slightly below 0.4, which is, by the way, a multi-decade low. And then when the correction takes place, you can watch until it rises to about, I don't know, 0.7, something like this, to take profits, to or to reposition yourself until something bigger happens. And this can go hand in hand with what we see on the charts, as you can see, especially on S&P 500, which is rallying hard today in the morning, but it didn't even come close to the typical range of correction that we saw in the 2020 first of all in June, then in September, and then in October we had corrections of let's say 300 points, something like this. So right now we only had 200 points, maybe even less. So when you look at the same stories with Nasdaq, that also isn't even close to this lesser correction here. So if you look at this typical range, you'd see that, okay, maybe, of course, you never know, it might be just a small profit taking, market can rally again, but if you are targeting a bigger correction, you should be watching this put-call ratio that could rise even further if there's a deeper correction, and this should go along with slightly deeper price declines. Okay, let's move on. Let's move on to the other markets. Euro dollar. Euro dollar is quite a no mover lately. So why are we going to discuss this today? Well, the reason is not even the Fed that was last week but did nothing, but it's more ECB, which is that signal that, look, be careful, because we can decrease interest rates even more. So why would they do that? They already have deposit rate at minus 0.5, and it doesn't seem to do much good for the economy. But of course, they have nothing else to do, and they see the euro strengthening against the dollar. So for me, this is kind of verbal intervention, and they really wanted to fend off this kind of thing. So they said this. But if you look at the broader picture of the euro dollar, then you will see that you have high positioning in the euro, low positioning in the dollar, spreads that favor the US dollar, and now this ECB threat. So taken together, this could add to the downside potential on the euro dollar pair. We already had this rally stopped here, and then we had some kind of stabilization, and but this could be just a pause in a slightly larger correction. Possibly this was the first wave to the down, and then we had slide of kind of a pause here, and I wouldn't be surprised to see a bigger leg down. At least the fundamentals would support such direction. Then we had Wall Street earnings, which are especially good in the tech sector, with earnings growth of 23% year over year, with 26 companies reported from the 100 of Nasdaq 100, and sales growth nearly 15%. So this is really strong. However, keep in mind that many of these stocks rallied 100% or more. So even though the business is good, they are even more overvalued. With the broader market, it's not so rosy anymore, because other than the tech, which is also doing very well in the S&P 500 sector, you can see the sales growth here is even stronger. Then you have other sectors of the more traditional economy, and these sectors are no longer doing that well. Moving on to the big companies reported last week, we had very strong results from Apple, Microsoft, Facebook, slightly more mixed results from Tesla, but like I said, that really had little market impact, immediate market impact, because markets were focused on other stuff. Now, oil market, that is still doing relatively well. If you look at Brent oil, it consolidates at the very high level following huge rally from the beginning of November last year. And if you were just seeing the chart, you would say, okay, but let's be on alert, because a deeper correction may occur, because it looks similar to this, when we also had huge rally from the spring, and then a consolidation around 45, and then a correction that ultimately took prices to 36. Now we had a rally towards 55, and we are consolidating around that level. And from a technical point of view, at least a profit taking towards 50 would make a lot of sense. And however, the bulls were strengthened by the new Secretary of State in the United States, Blinken, who said that the deal with Iran, which would be very negative for oil prices, because should the deal be made, let's imagine it's made today, and Iran is capable of returning with around 1 million barrels paid per day of oil tomorrow, and very quickly could prop it up to 2 millions per day. So obviously, without adjustment from the other producers, and with the economy still struggling a little bit, that could obviously affect prices very negatively. So with this new administration, the markets didn't know exactly what to expect, but Blinken said, look, the deal is very well possible. We want a deal, and Iran wants a deal too, but Iran is very far from compliance. So this is still a very remote possibility, still very remote date. So for the market, obviously, this is kind of a relief, because that's a sign that, okay, even if the deal is made, even if the oil arrives at the market, it will arrive maybe when the economy already recovers. So this is obviously good news, and this is news that makes this correction scenario slightly more complicated. And finally, last but not least, certainly, this silver rally that seems to be gathering steam. Silver is already up, well, nearly 20% from as recently as mid of last week. Obviously, the story is that, again, Reddit investors, that the retail investors want to corner the shorts on the market. Is that possible? Well, let me tell you this. This is a complicated story, because even though a short position on silver relative to the output is the largest of the precious metals, as you can see here, it's relatively benign to what we had in history, where it was even 0.7 of annual production. Right now it's less than 0.2, so it's not really that much. Also, the difficulty is that the idea of buying the ETF is a little bit misunderstood among the retail investors, because buying the ETF doesn't necessarily lift the price of physical metal. You need to remember that with the ETF market, there is a sponsor that issues shares that are then priced on the stock exchanges. So even if retail investors were about to increase their demand for the ETF units tremendously, the sponsors may decide not to issue more shares because they say, okay, we don't want to struggle with the constraints of the metal in the market, so let's wait and see until it settles down. So what would happen in that instance is that the price of the ETF would go up, even if a price of physical metal wouldn't go up as much. So that's a shortcoming of this approach. For the way I see it, if this kind of attack should be successful, it needs to be done via futures, because on the futures market it's much easier to corner the short, and you do not have the limitations like I just said via the ETF market. But then with the futures, the problem is that, first of all, the size of contract is too much for a lot of individual investors. That's the first thing. And the second thing is that the CFTC would probably at some point raise margins in order to, cool it down a little bit. So so quite simply, from many of technical issues, silver is much bigger target and much tougher target than GameStop shares or any shares like this. Having said that, silver has been doing very well this year. It was doing well last year, and it's never looked like this outlook could deteriorate massively. It stayed above the moving averages. It looked like it just was gathering some kind of steam over here, to trying to rest a little bit after this huge rally from the spring of 2020 and early summer of 2020. And with all the central bank actions that are fueling, they are printing a lot of money, they are fueling nervousness of the people who can no longer earn any interest, and they are looking for alternatives. Silver is looking good on all the fronts. So this hype that we can see around retail investors can still generate quite a rally here, even if it's not replicating the Jimmy, like I said, because that's close to impossible. It still could cause quite a significant rally here. So it's quite possible that we can see silver prices above 30 in the nearest future. Of course, at some point it may fizzle. It may, some of the people can be disappointed that, look, it's not what we want to achieve, and then the price will settle down again a little bit. But until that happens, it seems like there is some room for this market to still go up. All right, ladies and gentlemen, thank you very much for your attention. We see each other next Monday, 7:30 a.m. In meanwhile, I encourage you to read our news section on Xstation mobile platform, where we cover markets from 7 a.m. to 7 p.m. every day, providing news on indices, stocks, commodities, forex, economic reports. So you're much welcome to take advantage of that, and hopefully it supports your trading. Have a good week. We see each other next Monday.